Okay, so since I'll be presenting, I might not see when you raise your hand. So what you can do, just use the mic and don't be afraid to talk. Okay. So I believe you already went through the material that I sent in the group. Let us not waste time, then start working on it. Okay, so what I always encourage my learners to do is that before they try to write or to attempt the question, it is very important that they try to go through the information so that they can make sense out of it before they can answer anything. That way, they'll be able to identify certain items that is important. Okay, they are saying the following information relates to Lex Limited, which is a listed company, and their financial year it ended on 28th of February 2023. Then we are being required to complete the reconciliation between profit before tax, then and also the changes in working capital. So this is the first note when we prepare the cash flow, so that it can also aid us to calculate the total cash flow from operating activities. Then requirement number 2 is that we should prepare the operating activities section in the cash flow statement. Okay, then we are given information here. Extract from the statement of comprehensive income. We are given the operating profit. This one, I can't say we need it. We are having the operating expenses. This one, I can't say we need it. However, we are given the depreciation for the year. So we are going to need this one. We are also given the operating profit before interest expense, which is 510. We are also having the interest expense, which is 110,000. This one, we are going to need it. We are given the net profit before tax, which is 400,000. This one, we are also going to need it as well. Then we are given the income tax, which is 112,000. We are also going to need this one as well. Then we have the net profit after tax. So when we are going to prepare the reconciliation between profit before tax and changes in working capital note, from the extract from the statement of comprehensive income, we are only going to need the depreciation for the year. We are only going to need the interest expense and also the net profit before tax. Before we do anything, we have to reconcile our profits. Then on information B, they are saying the balances extracted from the statement of financial position. If you notice something, we are given, I can say, comparative amounts, meaning that we are given amounts from the previous year and amounts from the current financial year that just ended on the 28th of February. Now, if you notice something here, we are given the fixed or tangible assets at carrying value. The previous year, it was 1,250,000, but currently it's 1 million. Now, if you notice something, this means that the fixed or tangible assets decreased during the year, meaning that they might have disposed certain portion of their fixed assets. Then for inventory, from the previous financial year, it was 100,000. It's currently standing at 139,000, meaning that it has increased. Now, this means something. If inventory increase, it means that the business purchased inventory. Now, since we are dealing with cash flow, any increase in inventory, it is an outflow. Then trade receivables, if you notice something, from the previous year, it was 300,000. It's currently standing at 250,000, meaning that our trade receivables has decreased. Now, any decrease in trade receivables, it is an inflow. Then trade payables, if you notice again, from the previous year, it was 25,000. It's currently standing at 90,000 here, meaning that there is an increase in what? In trade payables. Now, any increase in trade payables, it is an inflow. Then again, we are having cash and cash equivalents. If you notice, from the previous year, it was 24,000. It's currently standing at 30,000. It means there is an increase in cash and cash equivalent, and increase in cash and cash equivalent, it's an inflow. Then again, we notice that there is SARS income tax. Now, from the previous year, they had a credit balance of 120,000. Then for the year ended, they also have a credit balance of 50,000. We are going to use the SARS income tax to calculate the taxation paid for the year. And tax paid, it's an outflow, so you should not be confused. Then we have mortgage loan from ABC Bank at 10% per annum interest. From the previous year, it was, here there was a mistake in terms of zero, it was 110,000. It's currently standing at 50,000. It means there is a decrease in loan, and a decrease in loan, it is an outflow, meaning that cash was paid to repay the loan or to reduce the loan. Then on information C, they are saying loan and interest on loan. They are saying the portion of the loan was repaid during the year and no additional loan was acquired. Remember, if they are making loan repayments, it means that cash is leaving the business. That is cash outflow. Then again, they're saying interest on loan is not capitalized, and the interest on loan paid for the year amounted to 110,000. Remember, under the operating activities section, we should show that interest was paid. Now, already here, they're telling us that for the year, they paid interest of 110,000. So this one, we are not going to calculate it. We'll just plug it there. Then we're being told that total dividends paid for the year amounted to 100,000. Even this one, we are not going to calculate it because it is given to us. So let's start working. Okay, let me record even on my side. Okay, I hope you were able to complete the activity though. So according to the structure or the format of the reconciliation between profit before tax and changes in working capital, we have to plug in or we have to record the net profit before the tax. Now, this one, we are going to get it from the statement of comprehensive income. And it's how much? It's 400,000 here. So it means on our note, we're going to record 400,000. Okay. Then again, we have to adjust our net profit before tax. We are going to add back the depreciation because the time we're preparing the statement of comprehensive income, we subtracted the depreciation. Now, since cash flow is dealing with cash items, cash paid or cash received, since depreciation, it is not a cash item, we have to adjust it, meaning that to remove it from our profit, we have to add it back. Then interest expense, it is not a what? It is not a, I can say it is not a non-cash item, because we know that from the interest expense for the year, some of it might have been paid while some of it might not be paid. So this one, we are adding it back simply because we are going to present it again separately so that we can determine the interest paid for the year. Okay. So how are we going to find the depreciation? The answer is simple. Even here, we are going to refer back to the statement of comprehensive income. Now, from the statement of comprehensive income, we can see that there is a depreciation of how much? There is a depreciation of 60,000. So to adjust it, since it's a non-cash item, it was previously subtracted the time they were determining the profit. We are going to adjust it by adding it back. So we're going to treat it as if it's an inflow. So we're going to say 60,000. Okay. Then again, we have to recall the interest expense. Remember, we are adjusting it, we are adding it again because we still have to calculate the interest that was paid for the year. Then this one, we are also going to find it in the statement of what? In the statement of comprehensive income. Now, how much is the interest expense? The interest expense, it's 110,000 here. So we're going to say 110,000. Then after that, we have to find the total adjustment, meaning that we're going to add the depreciation and also the interest expense together. So it will be 60,000 plus 110,000. Then that gives us 170,000. Okay. Now to find the profit before the changes in working capital, we're going to take the net profit before tax and we are going to add it with the adjustments. So it will be how much? It will be 400,000 plus 170,000. So let's see how much it gives us. So it's 400,000 plus 170,000. That gives us 570,000. I hope everyone got this one correct. Now, so far, is there any question? You can either use text or group messages, or you can just use your mic. You are permitted to use your mic. So is there any question or any addition? Okay, so if there is any question, then we can proceed. Okay, so now we have to show our changes in working capital. Remember, working capital, we are referring to inventory, trade receivables, and trade payables. Those are going to be our primary focus. Then here we have to show the movement or the changes in inventory. Remember, under the changes in working capital, this information, we are only going to find it in the statement of financial position. And our statement of financial position, it's information B. So we are first going to start with inventory. If you notice, our inventory increased. It increased from 100,000 from the previous year to 139,000 in the current year. So we're going to select the one that is applicable here. There is an increase. But the question is, how are we going to do this one? So since we are dealing with working capital, the easiest way in which you can calculate this, just start from the previous year to the current year. So remember, the previous year inventory was 100,000. And the current year it's 139,000. Now, when you compute the entire numbers on your calculator, it will give you a negative difference. That negative difference, it's a sign that an increase in inventory, it is an outflow. So we're going to have an outflow of 39,000. Okay. Then now we should also show the changes in the trade receivables. Now, if you notice something, our trade receivables from the previous year, it was 300,000. Then it's currently how much? 250,000. And remember, decrease in trade receivables, it's an inflow. But increase in trade receivables, it is an outflow. So here we are having a decrease. So we're going to say 300,000. Then we're going to subtract 250,000. That will give us how much? So 300,000 subtract 250,000. That gives us an inflow of 50,000. Okay. Then next up, we have to show the changes in our trade payables. Again, this information, we're going to find it from the statement of financial position. Now, if you check something here, the trade payables from the previous year, it was 25,000. It's currently 90,000, meaning that there is an increase. Now, any increase in trade payables, it's an inflow. So this one, we are not going to start from the previous year when we calculate it. We're going to start from the end of the current year. So it means we're going to start from the 90,000. 90,000. Then we're going to subtract from the previous year, which is 25,000. So we're going to say 90,000. Then we're going to subtract 25,000. That means there is an inflow of how much? Of 65,000. Okay. So now we've showed the changes in the working capital. What we have to do is to add everything up. Now, since some of the amounts for the likes of trade inventory, it is an outflow. Anything that is an outflow, it is a minus, and anything that is a positive or an inflow, it's a positive, I mean. So when we calculate the net change in working capital, it's very simple. The inflows, they are positives, and the outflows are negatives. So we're going to start from bottom up, meaning that it will be how much? It will be 65,000. Then we're going to add with the inflow of 50,000. But then since we are having outflow of inventory of 39,000, this one we cannot add it, but then we're going to subtract it. So we're going to subtract 39,000. Now, when we calculate everything together, it will give us the total changes in working capital. Again, if the entire amount gives you a negative, it will be an outflow. But if it gives you a positive number, then it is an inflow. So we're going to say 65,000. We're going to add with the 50,000. Then we're going to subtract 39,000. Then that gives us changes in working capital of 76,000. This is an inflow. So now we have to calculate the cash generated from operations. It means that we're going to add the profit before changes in working capital of 570,000 with the total changes in working capital of 76,000. And remember, our changes in working capital, it's not an outflow. If it was an outflow, it means we're going to subtract it. But now, since it's an inflow, we are going to add it. So it's going to be 570,000 plus 76,000. That'll give us how much? So 570,000 plus 76,000. That gives us 646,000. Okay, I hope everyone got this one correctly. If you are having any question, you can ask. Okay, if there is no question, then we can resume. Okay, so remember the second requirement is that we should prepare the section of the operating activities in the cash flow statement to show the net cash effect from operating activities. Remember earlier on in the reconciliation of profit before tax and changes in working capital, we only determine the cash generated from operations, from our day-to-day buying and selling of inventory. So now we also have to include other activities such as paying the interest, paying the dividends, and also paying the taxes. So now we are going to transfer the amount from our note, which is the cash generated from operations. Remember, it was 646,000. So this one, you are not going to wander around and ask yourself where you are going to find this amount because you've already calculated it. It's how much? It's 646, meaning that we are going to transfer it from there to our operating activities section. So it will be 646,000. Okay. Then now we have to do what? We have to record the interest that was paid for the year. Remember earlier on we adjusted the interest expense. Now remember our interest expense, it can include the interest that was either paid or not paid. But then under the net cash effect from operating activities, we only want the interest that was paid. I hope that is clear. Remember, since we went through the information, we were told that interest on the loan is not capitalized, and the interest on loan paid for the year, it amounted to 110,000. So this one, we are not going to wander around. We're going to come here and say interest paid. Remember, they said they paid it. Anything that says paid, it is an outflow. So it means that we're going to have brackets here. The question is, how much are we going to record? We're going to record the 110,000 for the interest on loan that was paid. So we're going to say 110,000. Okay. Then next up, we have to record the dividends that were paid. Remember, for the dividends that are paid, we are talking about the shareholders for dividends from the previous financial year and also the interim dividends that was paid for the year. That will be part of the dividends paid for the year. Okay, so here, information D, they're saying total dividends for the year, the dividends paid for the year amounted to 100,000. So even this one, we're going to plug it here, 100,000. Okay, then next up, we have to account for the taxation paid. Now for taxation paid, this one, it is going to come with many colors, many faces. It is very important that you try to familiarize yourself with the SARS income tax loan account. So now I'm going to show you how can we use the income tax, not the loan account, sorry, the income tax ledger account. Remember, SARS income tax, it is a liability account by nature. So it means we're going to say SARS income tax remember, it is a liability. It increase on the credit side and it decrease on the debit side. Okay, so we're going to use the information for SARS income tax to calculate the income tax paid. Now, from the previous year, it appeared as a credit balance of how much? Of 120,000. So it means on the credit side, we're going to say balance brought down. Then we record 120,000. Then here, it will be the income tax expense for this one will be from the statement of comprehensive income. Now, from the statement of comprehensive income, the income tax for the year, it's how much? It's 112,000. So we're going to say 112,000. Google, I don't need you. 112,000. Okay. Then here, we're going to write bank. This will be the income tax paid for the year. Remember, sometimes they're going to say the provisional payments for the year. Those provisional payments for the year are going to be your SARS income tax paid. That'll be your taxation paid for the year. Then now remember here, they said that there is also another credit balance here. So we are still going to bring the credit balance. Am I audible? Seems like my audio is off. Am I audible? Hello? Hello? Am I audible? Okay. Seems like I am now. Then since they said the SARS income tax, when the year ended, it says credit balance. It doesn't mean that it was closed off on the credit side. No, 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 no. This means that this is the face value of what? Of the SARS income tax when the books open or when we open our general ledgers in the next financial year. So meaning that since it says credit, you're going to come to the credit side and you're going to say balance brought down. Then it's how much? It's 50,000. Now, since it's opening on the credit side, it means that it closed on the debit side. Then we're going to say balance carried down. So you're going to transfer the 50,000 and bring it to the debit side because it was closed off on the debit side. So it will be 50,000. So using this information, we can calculate what? The income tax paid for the year, meaning that we're going to assess the bigger side first, then we'll determine it first. Based on this information, the bigger side is the credit side. If we take the 120,000, we add with 112,000, we're going to have a figure that is greater than that is appearing already on the debit side. So it will be 120,000. Then we're going to add it with 112,000. So it gives us 232,000. Then we're going to take the 232,000. We're going to transfer it to the debit side. Remember, double entry principle applies at all time. Our debit side should be equals to our credit side, meaning that on the debit side, the total side will be 232,000. Now we have the total debit side. We have the balance carried down. So what we're going to do, we're going to take the 232,000, we're going to subtract the 50,000, and that'll give us what? That'll give us the income tax paid for the year, which is 182,000. Okay, that is the first strategy that you can use to calculate the income tax paid. Now, the second strategy, if maybe you don't like using T accounts, you can just use straight lines. And the only way for you to understand straight lines is by using some short formulas. So now I just want to use this strategy as well for short formulas. So since the SARS income tax from the previous year, it's saying credit. If it says credit, what you have to do, you just say credit balance. You treat it as a positive. Then what you're going to do next, you're going to subtract, you're going to add, not subtract. You're going to add what? You're going to add the income tax for the year, which stands for IT. Then now, if the closing balance or the balance at the end of the year from the financial year, it says credit, you're going to say minus credit. So this one it's at beginning, then this one it's at end. So now at the beginning, the SARS income tax had a credit balance. Then it says 120,000. Then remember here we have to add the income tax, which stands for IT. And our IT from the statement of comprehensive income, it's 112,000. Then we're going to say plus 112,000. Then we have to subtract what? We have to subtract the SARS income tax at the end of the year. So it's saying credit. Remember, if at the end it says credit, then we have to subtract. That is the rule. So at the end, it's 50,000. So we're going to subtract the 50,000. So when we calculate everything, it should give us the same amount that we got the time we're preparing the SARS income tax account. So it will be 120,000 plus 112,000, then minus 50,000. It gives us 182,000. There might be other approaches out there that you should use for your own advantage. Then since we got the same figures here, then we can go back and calculate it. Remember, under your cash flow, you cannot prepare the T account. So by fire, by force, you are forced to use the straight line method. So it will be 120,000 plus 112,000 minus 50,000. Remember, they paid the tax. They paid 182,000. It means it is an outflow. Okay. So now in terms of this one, when we have to calculate the net cash effect from operating activities, there are going to be change in rules. If all of them they are in brackets, meaning that they are all outflows, you add them together, then you say this is the total outflow from the cash effect from operating activities. But since here we are having 3 outflows and a 1 inflow, we're going to use the inflow to subtract all the outflows. Then the calculator, if it gives us a negative amount, then that is a net outflow. Then if it gives us a positive amount, then that is a net inflow. So we're going to start from cash generated from operations here. So it will be 646,000. Interest paid, dividends paid, and taxation paid. These ones are always outflow. So we're going to subtract them. So we're going to subtract 110,000. We're going to subtract 100,000. And we're going to subtract 182,000. That'll give us the net cash effect from operating activities. So it's going to be 646,000. We're going to subtract 110,000. We're going to subtract 100,000. Then we're also going to subtract the taxation paid of 182,000. Then that gives us a positive amount, meaning that the net cash effect from operating activities, it's an inflow of 254,000. Then that is how we calculate it. So is there any question? Okay, someone is saying, sir, let me read the text. Okay, someone is saying, sir, could you please give us the straight line formula if it were a debit balance instead of a credit balance? Okay, so let me just do this since you asked. Okay, so the debit balance, it can either be on the, okay, the debit balance, it means the debit. So let's just do it this way. So let's say it's SARS income tax. SARS income tax. Then it's 20, let me do this. 2023, 2022. Let's assume here it says 1,000. Then it says debit. Then it says, let's just say, let me write 8,000. 8,000. Let me just write 800. Then credit. Okay. Then let's assume that the income tax for the year from the statement of comprehensive income, it's just 500. Hopefully it will balance. Now, if it's a T account, I just want to start with the T account before you can use the straight line way. So if it's a T account, we're going to say SARS income tax. SARS income tax. Remember, it's a liability. It increases on the credit side, it decreases on the debit side. So since here, the balance from the previous financial year, it says debit. You're going to come to the debit side and you're going to say balance brought down. then it was 100, not 100, but 1,000. Then here on the credit side, you would still record the income tax for the year. Now the income tax, it's 500. Then you record 500. Then here, since it said it's saying credit, then it means you would do it this way. Then you'd say balance brought down, which is how much? 800. Then you say 800. Then you bring it here. Then you would have the bank, which will be the balancing figure. And here another balance carried down of 800. Then if it's like this, it's impossible because my income tax, it's what? I can say it's less. So let me just try to put it as 3,000. Then obviously the bigger side is the credit side. Then you would say 3,000. Then you bring it to the debit side, it becomes 3,000 as well. So to calculate the income tax paid for the year, then you would take the 300, the 3,000, I mean, then you subtract the 800, you subtract the 1,000. That'll give you 1,200. So if it's like this, then the formula will be simple. So it means since it's debit credit, then you would start with a what? You would say the credit and the debit. So since here, if you check, it started with a debit, then you're going to say negative debit. Then you're going to add the income tax. Then you're going to subtract the credit balance at the end. Then it will be how much? It will be 1,000. Then we're going to add not 1,000 but negative 1,000. Then we're going to add the income tax, which is 3,000. Then we subtract the 800. So let's see how much that gives us. So since this one, it says it's a what, negative, then it should be like this, plus 3,000 minus 800. It gives us 1,200. Here root 12,000, it's 1,200. That is the first formula. If maybe it's a debit and a credit. So again, it can say, let me just show it this way before we proceed. I hope you understand the first one, since you said debit and credit. So now I want to show you if it's the opposite. So let's assume now it's 4,000 here. Then it says debit. Then it says 5,000 here. Then it says credit. Then the income tax is still the same. Okay, then here, if you notice, it says a credit balance. Then it means we're going to say balance brought down on the credit side. Then we record the 5,000. Then remember, we still have the income tax. The income tax, it's how much? It's 3,000. Then we record the 3,000. But this time around, it says it's a debit balance, meaning that I will come on my debit side. Then I will say balance brought down, which is 4,000. Then I'm going to bring it here. Then here it will be balance carried down of 4,000. So already we know the bigger side. The bigger side is the credit side. So here bank will be our balancing figure. So we're going to add everything on the credit side, then it will be 5,000 plus 3,000 plus 4,000. That gives us 12,000. Then we're going to bring the 12,000 to the debit side. Then that means the total income tax paid for the year, it's how much? It's 12,000. Then when we are using the formula, let me show you how it's going to be. Remember, credit balance, it's a positive. Then we're going to add the income tax for the year. Then this time around, since the end balance, it says debit, then we're going to say plus debit. That is the third way of doing it. Now let's just go through the fourth way of doing it. The third, let me resume it first. Then it's going to be the opening of 5,000 plus the income tax for the year of 3,000 plus the debit balance of 4,000. So it will be 5,000 plus 3,000 plus 4,000. It's 12,000. So in case SARS income tax says that it's a credit at the beginning, then at the end it's a debit. A debit means that SARS is owing us. It will appear under the current assets. Okay, so now let's see if maybe all of them, they are debits, and how are we going to treat it. This is the fourth way of doing it. It can come in any way, but there are four ways of doing it. Okay, so this time around, let's assume that it's debit. It's 10,000. Then it says debit. Then again, it's, let's say it's 15,000. Then it says debit. Then our income tax can be, let's see, 20,000. Will that be enough? Okay. Let's say 30,000. Let's hope it's enough. Then now, since we're having a debit here, then it means here would say balance brought down. Then would write 10,000. Then here would write the income tax. It's how much? It's 30,000. Then remember, we are having another debit here. So it means here we would do what? We would say Remember, our bank should be the balancing figure. Then we'd say balance brought down, which is 15,000. Okay, then we'd bring it here and say balance carried down of 15,000. Then if you want to find the bigger side, is the credit side. So we're going to add the 30,000 with the 15,000. That gives us total credit side of 45,000. Then we bring the 45,000 here on the debit side. Then now to find the income tax paid, then we take the 45,000, we subtract the 10,000. It gives us 35,000. So when it's like this, how can we do it on a straight line? So the answer, it's simple. This one, what we are going to do, we're going to say a debit. It will start with a negative debit. Thereafter, you're going to add what? You're going to add the IT, which is the income tax. Then we're also going to add what? You're also going to add the debit balance at the end. Then that's how we do it. So it means it will be how much? Remember, the debit here is 10,000. So it will be negative 10,000. Then we add with the income tax for the year, which is 30,000. And we add with another debit, which is 15,000. That'll give us the income tax paid. So it will be negative 10,000, then plus 30,000, plus 15,000. That gives us 35,000. So I showed you 4 ways in which it can come, and also the formulas that you can use in case you want to calculate it using the straight line approach. I hope it's clear there, Amanda Kumisa. You are welcome, Amanda. Okay, then let's do the next activity. Then we can end it here. What time is it? It's almost midnight. Okay, so here they said the following information relates to Lex Limited, a listed company. Then their financial year, it ended on 28th of February 2023. They're saying complete the reconciliation between profit before tax and changes in working capital note. And they are also saying that we should prepare the operating activity section in the cash flow statement and also the investing activity section in the cash flow. Remember, we have 3 activities in our cash flow. We have the operating activity section, we have the investing activity section, and we also have the financing activity section. So here we have an additional one, which is the investing activities. Remember, before you can start writing, go through the information so that you can make sense out of it. Okay, we're going to start with extract A. They are saying extract from the statement of comprehensive income for the year. Then we are given depreciation. We know that depreciation, we're going to use it when we adjust our profit. We also have the income tax. We have the interest expense. We are going to use the interest expense to adjust our profit. We have the income tax. We can use the income tax to calculate the income tax that was paid. and we also have the net profit after tax. Then again, we have an extract from the statement of financial position, which is balance sheet. Then we have the fixed or tangible asset at carrying value. Now we can use the fixed or tangible asset at carrying value to find addition of fixed assets and also disposal of fixed asset. Okay. Then we also have fixed deposit. This one, the fixed or tangible asset and the fixed deposit, these are investing activities. If you notice, fixed or tangible asset, it has increased, but then it doesn't mean that it was only addition. It can also be portion of fixed asset that was disposed. Then we also have the fixed deposit. If you notice, it has decreased, and a decrease in fixed deposit, by the way, it's a financial asset. It is an investment. Any decrease in investment, it is an inflow. It means whatever we invested has matured. The money was returned to us. Then we have trade inventory. Like before, it has increased. Any increase in trade inventory, it's a what? It is an outflow. Then we have accrued income this time around. Before that, we have the trade receivables. If you notice, trade receivables, it's 300,000. Then when the year ended, it's 250,000. Now, any decrease in trade receivables, it is an inflow. Then we have accrued income. When the year started, it was 3,000. When the year ended, it's how much? It's 7,000. So this one, it has increased, but then we're going to use it to calculate the total trade receivables for the year. Then we also have trade payables. At the beginning of the year, it was 25,000. Then when the year ended, it's 90,000. We also have accrued expense. It's 1,200. Then it's 3,500 at the end. But now, if you pay attention, the accrued expense, it's for water and electricity. Water and electricity, it is an expense. So the only way in which we can adjust an operating expense is through the what? The reconciliation between the profit before tax and changes in working capital note. We don't want the interest on loan. Then if you check, we have SARS income tax this time around. It says the opening, it's a credit. Then the SARS income tax, it's a debit. Then we also have the mortgage loan. It was 2 million when the year started. It's currently standing at 1,500,000. It means they paid. And decrease in loan, it is an outflow. Then this time around, they said shareholders for dividends. It's how much? At the beginning, it was 90,000. When we start paying the dividends, we're going to start paying the shareholders for dividends at the beginning. Then we'll also pay the interest, the interim dividends, I mean. Then we also have the shareholders for dividends at the end, which is 60,000. So we're going to use all this information to calculate whatever is being required. Then information, see they are saying loan and interest on loan. We have the portion of the loan. They're saying portion of the loan was repaid during the year. An additional loan of 200,000 was received during the year. Okay, interesting, they paid. Then they also made an addition of loan. Then we have the interest on loan. They're saying it's not capitalized, and the interest on loan paid for the year, it amounted to 220,000. If you notice something, the interest expense is 200,000, but the interest that was paid is 220,000. Very, very interesting. Then we are given information that relates to fixed or tangible asset. They are saying fixed or tangible asset and fixed deposit. New building was purchased during the year, and there were no disposal of fixed deposit. Not fixed deposit, but fixed asset. Ne? Sorry for this minor error. Meaning that they acquired additional buildings. They did not dispose any fixed assets. Then they're saying the fixed deposit matured and the amount was deposited to the business bank account. It means here it is a decrease in fixed deposit, and a decrease in fixed deposit, it is an inflow. Then on E, we are told that the interim dividends for the year, it amounted to 40,000, and the final dividends declared amounted to 60,000. So we're going to use this information to determine the dividends paid for the year. Okay, so now let's start working. So remember, in our note, we have to start by recording the net profit before tax. If you notice something here, we are given the net profit after tax and also the income tax. And to find the net profit after tax, we took the net profit before tax and we subtracted the income tax. So now, since we want the net profit before tax, we're going to do the opposite. We're going to take the net profit after tax and we're going to add back the income tax. So it will be 503,640. Then we're going to add 195,860. So 503,640 plus 195,860. That'll give us net profit before tax of 699,500. Remember, we still have to adjust our profit. So they are saying depreciation. The question is, where are we going to find the depreciation? We're going to find it from the statement of comprehensive income. It's 90,000 here. So it means here we're going to add back the 90,000. Then we also want the interest expense. Where are we going to get it? We're going to get it from the interest expense part in the statement of comprehensive income is 200,000. Then here we're going to say 200,000. Now, since we're previously subtracted, we are adjusting them by adding them back. So now to find the total adjustment, it will be 90,000 plus 200,000. So 90,000 plus 200,000. That gives us total adjustment of 290,000. So now when we want our profit before changes in working capital, we're going to take the 699,500 and we're going to add 290,000. So it will be 699,500 add 290,000. That gives us 989,500. Okay. Then what do we do next? So next up, it should be the changes in the working capital, whereby we first have to start with the changes in inventory. Now, the only way to find this information is from the statement of financial position. So here, if you notice, we have information relating to trade inventory. When the year started, it was 100,000. When the year ended, it's 139,000. It means it has increased, and an increase in inventory, it's an outflow. So remember, this one we start from the previous to the current. So it will be 100,000. Then we're going to subtract 139,000. If it gives us a negative amount, then it is an outflow. So we're going to say 100,000, then we're going to subtract 139,000. That gives us outflow of 39,000. So we're going to say outflow of 39,000. Then now it's the trade receivables. Okay, so for trade receivables, we're going to refer to, let me do this. So we're going to refer to these two items here. Okay, so what we are going to do, we're going to add them together. Then that'll give us the total receivables. Okay. So since this one, it says it's a decrease, then obviously there is an inflow, but we are going to see how much the inflow is. So it's going to be 300,000 plus the 3,000 for the accrued income. Then we're going to subtract the 250,000 plus the 7,000. Then let's see how much it gives us. So it's 300,000 plus 3,000 minus 250,000 plus 7,000. Then it's outflow of 46,000, not outflow but inflow of 46,000. Since it's a decrease. Then next up, it will be our changes in trade payables. So here we're going to consider the trade payables and also the accrued expense, but only for the expense part, not the interest expense. Then even here, if you notice, it shows that there is an increase. So we're going to say 90,000 plus 3,500. Then we're going to subtract 25,000 plus 1,200. It's 90,000 plus 3,500 minus 25,000 plus 1,200. That gives us how much? 67,300. Remember, it has increased. Then it is an inflow. Then now we have to find the total changes in working capital. Remember, start with the inflows, then you subtract the outflows. So it will be 67,300 plus 46,000. Then we subtract outflow of 39,000. Then that'll give us how much? So it will be 67,300 plus 46,000. Then subtract 39,000. That gives us inflow of 74,300. So now we want to find the total cash generated from operations. So it will be the 989,500 for the profit before changes in working capital, and the inflow for the changes in working capital of 74,300. So we're going to say plus 989,500. That gives us 1,063,800. Okay, so is there any question so far? Okay, if there is no question, then we can move on. Then now we have to prepare the cash effect from operating activities. So remember, the cash generated from operations, we have determined it. It's 1,063,800. Then we have to record the interest paid. Remember, earlier on, we adjusted the interest expense. There is a difference between interest expense and interest paid. The one from the statement of comprehensive income is the interest expense. But the interest paid, we're going to refer to information C, bullet number 2. They are saying interest on loan is not capitalized, and the interest on loan paid for the year, it amounted to 220,000. So we're going to come here and say 220,000. Then for dividends paid, the answer is simple. So this one, the formula to calculate the dividends paid, we're going to say shareholders for dividends, SD, let me just say SFD, shareholders for dividends at the beginning. Then we're going to say plus interim dividends. So this will be the formula. So for dividends paid, if you notice, the previous year, they had shareholders for dividends, which will be the shareholders for dividends at the beginning of the year. So we're going to say 90,000. Then we're going to do what? We're going to add with the interim dividends for the year, which is 40,000. That will give us the total dividends paid for the year. So it will be 90,000 plus 40,000. That gives us the dividends paid of 130,000. Okay. Then next up, we have to calculate taxation paid. So since I already did the formulas for you, then now we are applying those formulas. So for income tax, if you notice, it says credit balance. Then again, it also says debit balance. Then the income tax for the year, it's 195,860. Okay, so when it's like this, it means it is that one whereby we're going to add everything. So we're going to say SARS income tax. Then we're going to say debit. We're going to say credit. It increase on the credit side and it decrease on the debit side. Now the balance says credit. So we're going to say balance brought down, which is 120,000. Then here it will be income tax. Now the income tax, it's 195,860. Then bank will be our balancing figure. Then here it says debit. Then we're going to say on the debit side, balance brought down of 50,000. Then we're going to bring it to the credit. Then it will be balance carried down of 50,000. So this means that the bigger side will be the credit side. We're going to add everything. So it will be 120,000 plus 195,860 plus 50,000. That gives us 365,850. Then we bring it here, 365,860. Then this means that the income tax paid for the year is 365,860. Now, when we're using the straight line method, this is that formula by it will be credit plus the income tax. Then we also say plus debit. So it will be 120,000 plus 195,860 plus 50,000. That'll give us income tax paid of 365,860. So I'm going to say 300 and oh, should be 120,000 plus 195,860 plus 50,000. That gives us income tax expense paid of 365,860. Not necessarily an expense though. Then now we have to determine the total net change. Remember, outflows, you put them in brackets. Since they're outflows, it means we're going to subtract them. So we're going to start with the cash generated from operations of 1,063,800. Then we're going to subtract 220,000. Then we're going to subtract 130,000. Then we're also going to subtract 365,860. Okay, 1,065,800 subtract 220,000, subtract 130,000, subtract 365,860. Then that gives us 349,940. It is an inflow, by the way. So for this one, is there any question? Okay, silence means there is no question. Okay, then we can go to the next requirement, which will be the net cash effect from investing activities. Okay, remember, for investing activities, if we are disposing a fixed asset, we're going to dispose it at carrying value and for cash, meaning that that will be an inflow. But if we acquire additional fixed asset, that'll be an outflow because we are paying cash for that purchase. Then if there is an increase in investment, then it is an outflow. And again, if there is a fixed deposit that decreases, then it is an inflow. So here, under the investing activities, we're going to focus on two things: the movement of the fixed or tangible assets, and also the movement of our fixed deposits. Okay. Now, remember, additional information D. They said fixed deposit or tangible asset, and also the fixed deposit. They're saying new building was purchased during the year and there was no disposal of fixed deposit. So here we are not going to struggle that much. So since they said there is a purchase, then we're going to say purchase of fixed asset. So the information that is an extract there for this from the statement of financial position, it is at carrying value, and we know that the carrying value, to find it, accumulated depreciation was subtracted, and accumulated depreciation is made up of depreciation from the previous financial years, meaning that the depreciation of the fixed asset might have been included there. But then we know that land and building does not depreciate. But then we are compelled to use the depreciation to find the additional land and building that was purchased. So now let me show you this formula. So if you are familiar with mathematics, it is going to be easier for you to solve it. So remember, for you to find the carrying value at the end, what did you do first? You took the carrying value at the beginning and you added additional asset that was purchased. Then after, you would subtract disposal at carrying value, or the carrying value of the disposed asset. Let me just say disposal at carrying value so that you'll remember the fixed asset node. Disposal at carrying value. Then you would again subtract the depreciation for the year. Then the answer that we'll be getting will be the carrying value at the end of the year. Now on our side, we can substitute everything so that we can find whatever is missing. First of all, the carrying value at the end, it's how much? So it will be 1,550,000. Then the carrying value at the beginning, it's how much? 1,250,000. Now, since disposal at carrying value, it's a balancing figure. We don't have any disposal, I mean. So it means under addition, we're going to say plus, it will now become our X. It's a balancing figure. Now for disposal, we don't have anything. So we cannot write it. You can just put 0 if you prefer. Then we're going to subtract the depreciation, which is how much? Remember the 90,000. So it will be 90,000. Then we can just turn the equation around to find the missing figure. Now to make X the subject of the formula, we have to transfer the amounts from the right side to the left side, meaning that they are going to change signs. So it means here we're going to have 1,550,000. Then since we bring the 1,250,000, it will change a sign, it will become a negative, meaning that it will be minus 1,250,000. Now, since this one it's a negative, when it comes to the left side, it will now become a positive. So it will be 90,000. Then we're going to find the cost of the additional land and building. So it will be 1,550,000. Then we're going to subtract 1,250,000. Then we're going to add the depreciation of 90,000. That means the cost of the additional land and buildings, it was 390,000. So you can just use the equation to solve whatever you are trying to find there. So we call this the 5 fingers method. Okay, so here it will be the carrying value at the end of 1,550,000. We're going to subtract the carrying value at the beginning of 1,250,000. Then we're going to add the depreciation of 90,000. Remember, they are buying, purchase or addition. It is an outflow because cash is being paid to acquire the fixed asset. So we're going to say negative or outflow of 390,000. Okay. Then now we're being told that there were no disposal. It means we cannot say proceed from sale or fixed asset. Then one thing that we have to account for now, it's the fixed deposit that has matured. We're being told that on Boolean number 2 that fixed deposit matured and the amount was deposited to the business bank account. So if we notice here, the fixed deposit, it has decreased. So we're going to say decrease in fixed deposit. So we're going to say decrease in fixed deposit. So decrease in fixed deposit. Then the previous year it was 190,000. Then it's currently standing at how much? 100,000. It means that it matured. Then we're going to say subtract 100,000. So we're going to say 190,000. Then we subtract 100,000. That gives us an inflow of 90,000. Okay. So now we have to calculate the net cash effect from investing activity. So remember, we start with the inflow, then we subtract the outflows. So remember, the inflow is how much? It's 90,000. Then the outflow is how much? 390,000. So we're going to subtract 390,000. Then when we take the 90,000, we subtract 390,000. It gives us outflow of 100,000. Then we are done with our activity. So is there any question? Okay, because if we don't have any question, I would like for us to just end here. There are still additional activities that you have to complete though. But then for us, in terms of cash flow, we are ending here, guys. So if you don't have any question, I believe that you ask them while you are practicing. Now, again, for you to pass, it is easy for you to pass accounting. But now, if you say that you feel like you are mastering it by just completing one activity, let me tell you, you are wrong. For you to say that you are the best in accounting, practice, practice, and practice. Never stop practicing. Because the more you practice, the more your eyes are going to open and the more you are going to be able to solve complex problems. Yes, you are allowed. You are allowed to inbox me. Ne? No one is going to say no, 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 no. Just text anytime. When I see your message, then I'll reply to you. So don't stress. So what I'm going to do, I will send you this other material. The material, it has previous question papers. Make sure that you complete those activities there. If there are 10, make sure that you complete 10. Then another thing, I'll try to download the trial exam question papers from all 9 provinces. So make sure that before you enter the exam room for accounting, you wrote, you practiced, let me just say you practice all 10 of them. Then I assure you examination is not going to grill you. So if you don't have any question, then we can just close the lesson here for the night. Okay, thank you guys. Enjoy the rest of your, can't say your night because it's already midnight. And good morning, by the way. Enjoy. Goodbye, guys. Thank you for attending.